Let's bring in Trivariate's Adam Parker now as the shutdown gets underway and we kick off trading for October and Q4. Adam, good to have you with us.
How are you?
I'm good. A lot of discussion about what a pleasant surprise September was in Q3 and NDX up 9. You think that can continue into Q4? And how does the shutdown play into that?
So, yeah, two things to unpack there. I mean, if you look back in history, we looked at 98 years of data. 39 times the market was up in the first 3 quarters, 10% or more. And in those years, the Q4 was better than average with lower volatility than average. So history would say Q4 should be pretty good just based on the fact that people don't lock in strong returns typically. They chase more. So that's kind of the first thing you said. In terms of the shutdown, look, I would say the statistical significance is low. We had that 35-day period of 2018, 2019. We've had several other shorter ones. I think institutional investors I talk to are kind of taking I don't think I should position for it differently now sort of view, and then we'll see if we have to worry about it. So I don't know anybody who's doing a lot of trading around it at the current moment.
Right. One thing's for sure, your healthcare trade is finally coming around. the healthcare index, back to April levels now.
Yeah, it's been a bad call, but it's worked recently. My view is that healthcare is the area where we're going to see the most benefits on the productivity side from AI. I think a lot of that's 2026 and 2027. We've been highlighting drug distributors like McKesson, Cencora Cardinal, Quest, like businesses that have a lot of employees and low margins and therefore can benefit as they implement, predicting their customer and employee behavior better.
I know, the old adages don't trade on a shutdown and it'll just reverse economically. But now that there is this threat, from the White House budget director of mass firings, rather than just, furloughs, at a time where ADP this morning showed another month of declining job growth. We've seen signs all over the place of labor softness. Does it make you rethink at all the trajectory for the job market, which is really holding the consumer and the economy together?
Hi, Sarah. Not really is the short answer to your question. Meaning, I think the bull pillars are, one, productivity from AI coming in 27 and beyond, as we, from all the spend, and two, the distribution of outcomes for the Fed is more dovish. So most equity guys are going to say, look, Sarah, do I want to fight the S&P tape in a holistic way if the Fed's going to get more dovish and margins are going up for the average company? No, I don't. Now, whenever you phrase it the way you did, is it all more worrisome? And yeah, it could be, but I just think right now people aren't going to sell the dream of some of the upside productivity just because there's so
the AI trumps everything. Is that basically it?
It's in the innocent until proven guilty mode still. Yeah.
And does that work for the entire market or just for the mega cap tech?
The biggest worrisome thing, we do a lot of risk management work for institutional investors at Trivariate, and the biggest worrisome thing I see is the correlation between, let's call it the alternative asset managers, even the big three, Goldman, Morgan Stanley, JP Morgan, and let's say industrials like Eaton and Caterpillar, and obviously Power, GE Vernova, Vistra, Constellation. They are all highly correlated to AI semis. So the challenge is you have these different sector bets in your book, industrials, alternative asset managers and financials, semis, and power, and yet they're all really correlated. So I think the real risk is that when that gets out of favor, a lot will roll over, and then maybe Carl, the healthcare thing will look good during that regime too. So I think you've got to find other things. We wrote at Trivariate last week, what stuff is correlated at a very low level, like 0.2 or lower to the AI semis, but is also up year to date. So I'm trying to find things that are working both fundamentally and stock-wise that aren't the exact same trade as everything else I just listed, because that is the fear I have, that when it unwinds, it'll be sharpened across multiple sectors.
Right.
Yeah, although, Adam, typically when something unwinds like that big, everything gets hit. I mean, there's no place to hide. Is there really?
Well, yeah, I think if the market goes down 10%, it'll be hard to hide, but maybe you can be down 2 or 3 in certain areas. And I think the challenge is historically the playbook would say, buy staples or something like that. But as you've seen, they don't have pricing power versus, the big kind of consumer companies like Walmart, Costco, and Amazon, or there's GLP-1s or other things that are impairing them. So the classic defensive playbook has been a little bit impaired too. And so I think people are struggling with, is the new defensive something that's not disrupted by AI, meaning aggregates, Vulcan or Martin Marietta or waste management or something that I know I kind of need in 2030, independent of what the AI, landscape looks like.
Right. Although WM is a proxy for economic activity too. It's a good point about where you would turn. Adam, we'll continue the conversation soon. Thanks, Adam Parker. Good to see you.